Good morning, everyone. This is Dana from NexGen. We are kicking off our Budget 102 series with two questions. One, why is my personal budget not working for me? And two, am I not making enough money? A budget is an estimation of income and expenses. Our personal budgets are supposed to be useful in helping us manage our finances, allegedly. If our objective is generational wealth, we're going to have to do more than manage our finances. Most of the time, we are managing debt. I would like to share some information with you that I think will be helpful and jumpstart our generational wealth journey. Let's look at the types of personal consumer debt and how they work. These are the different types of debt. The main types of personal debts are secured and unsecured debt. Secured debts require collateral, such as a car, while unsecured debt is based solely on a person's creditworthiness. Unsecured debt does not require collateral. When a lender makes a loan with no assets held as collateral, they are relying on the borrower's ability to repay the loan. Because this is riskier for the lender, unsecured debt usually carries a higher interest rate. Examples of unsecured debt could include credit cards, signature loans, and medical bills. Debt can also be by revolving or by installment. Revolving debt comes with a credit limit, and you can use it as many times as you need to, as long as you do not exceed the credit limit, and it usually comes with a credit limit. You must make at least the minimum payments, and the remaining balance that you may have will transfer over to the next month, with interest in most cases. With installment loans, the lender provides a lump sum which you would have to repay in regular payments that are typically the same amount each month for a set period of time. So revolving debt, an example could be credit cards, where you're paying the minimum and you can use it as many times as you need to. Whereas an installment loan, or for example, a car loan, it's for a set period of time and there are regular payments and you make them the same amount every month. Now we have the fixed rate debt and the variable rate debt, and they differ on how the interest rates are structured. So with a fixed rate debt, the interest rate remains the same through the entire term of the loan. With variable rate, the interest rate changes from time to time and is based on market conditions. An example of a fixed rate debt would be a fixed rate mortgage. An example of a variable rate debt could be home equity lines of credit that change every month. And again, it usually is based on market conditions. Debt that has a maturity of 1 year or less will go into the short-term debt category, whereas long-term debt has a repayment period of exceeding 1 year. Those are the different types of debt, and we take on debt in the form of loans. These are the different types of loans that are secured, unsecured, revolving, by installment, fixed, variable, short, and long term. What they all have in common is that they can wreak havoc on our budget and make us feel like we're not making enough money. Let me show you what I mean. Some of you may have seen this from a previous video where I actually showed you the credit card statement. But the $12,549.99, that represents the credit card balance. If the balance is paid in full before it starts accruing interest, then we have no problem. If you make at least the minimum payment, which in this case is 2% of the balance, and make no additional purchases, it would take you up to 46 years and almost $38,000. If you make the minimum payment and make additional purchases and carry the balance, you will never pay the balance. What adds insult to injury is the card company, because you are so good, will increase your credit limit. I have no idea how much will have been paid on this card, but it's a safe bet it will be more than $40,000. This is in addition to all your other expenses. Speaking of expenses, mortgages are the most common and largest debt in the United States. A mortgage typically has one of the lowest interest rates of any of the consumer loan products, and loans are mostly issued between 15 and 30-year terms. So in this scenario, I would like to show you a 30-year fixed rate mortgage for $450,000. So what I'm giving you is the principal and the interest only. So if the interest rate was 3.5%, the monthly payment would be $2,020.70. With the interest, you will have paid $727,452.39. Now, usually that's the type of interest rate you would have seen in 2018, 2019. Today, with the interest rate looking at 7.5%, that same mortgage, your monthly payment would be $3,146.47. With the interest rate, your total would be $1,132,727.50. Now, this if you did the entire 30 years and you did not refinance. Because if you refinance, unless you refinance to a lower term, you basically would be starting the clock over again. So I like to end on a positive note, as always. So I would like to share a different scenario. So instead of taking the 30 years to pay this mortgage, why don't we pay this mortgage off in 5 years? I will include a link in the description below on how this can be done without a second job or a side hustle. After you pay the mortgage off and you don't know what to do with the extra funds, let me help you. Okay, so if you were comfortable with the monthly payments, I'm going to show you what you can do with the remaining 25 years. So if the interest rate was 3.5%, after 25 years, the total deposit in your family bank would be $970,547.49. If you were using the interest rate of 7.5%, then the total would be $2,787,720.77. For those that want to check, I will include the calculator below. So if you absolutely have to have a tax write-off, then I would invite you to take a look at IRS Schedule A, Form 1040, line 11. You're welcome. The reason we are including types of debt and loan products in our Budget 102 series is because when we are managing our finances, we sometimes focus on monthly expenses instead of our financial portfolio in its entirety. Just so you know, that is by design. More on that later. Don't forget to like, share, and subscribe to our channel, and I will talk to you soon.